Good evening, everybody. Richard Maud here, founder of VemaTrader, and I am excited to have so many of you on the call tonight to check out some new updates that we've got coming to VemaTrader, and also to be covering what expected value is, how to calculate it, and why it's the single best metric to analyze your trading performance. So just before we get into that, though, I want to show you two things that are coming to VemaTrader very, very shortly. I am sharing my screen. I'm hoping that you can see my VemaTrader now. Give us a thumbs up or a thing in the chat just to let us know you can. Awesome. Thank you very much. Rightio. So here, this is our test environment. So everything I show you on this is not exactly on production available for all customers yet, but it does let us preview things and test that things are working correctly. So the first thing I'll show you here is BitGet. We are currently integrating the BitGet exchange inside of VemaTrader. We've been working on that one for probably about 4 to 6 weeks now. And super excitingly, it is like this close to being finished. So that's awesome. We are going to be doing some cross-promotional pieces with them as well, which is also super cool. And we will be doing a beta testing of BitGet trading starting next week on Monday. So if you are interested in helping us test out BitGet, then please reach out, support@VemaTrader, and let us know, hey, I want to help you test BitGet. In return for doing that, we give you a little bit of a discount on your subscription for a month, just as a thank you. Now, we're super, super confident that there's not going to be any issues with it. Otherwise, we wouldn't offer you the Vema Insurance Fund, which is if you were to lose a trade or lose money through Vema or trading against BitGet because Vema made a mistake and just didn't have the stop loss there for some reason, then we'll cover that loss for you up to $1,000. But if it was your own trade, like, hey, you went long and it went short and your stop loss get hit, hey, that's on you. But if it's a stuff up on Vema's part, then we'll cover the loss for you. So if you're interested in helping us out with that, that'd be awesome. We'd love to hear from you. The second one we've got that's coming out hopefully next week. It might be the week after. I can't guarantee things because the BitGet is the #1 priority at the moment. The second one is that a lot of people say, well, hang on, I can only chart certain data inside of Vema. I want to look at the DXY. I want to look at Bitcoin dominance. I want to look at the total market cap, or I want to look at a kind of a shares or something else. I want to look at gold from a different exchange. So in the next release of VemaTrader, when you go to exchange, you'll be able to see market data up the top here. And so on the market data, this is a different trading view interface. So while it is the same trading view, it's not the same SDK. We will be changing the watch list on here. So let's go and check out BTC dominance for an example. We'll get rid of volume. And so now we can see that, oh, cool, Bitcoin dominance is updating itself in real time directly inside of VemaTrader, which is super cool. So you can jump over to this one and say, let's go check that out on the weekly. And now we're looking at Bitcoin dominance on the weekly. If you wanted to switch that over to something else, then you could click up here and you've basically got all the symbols that are available inside of trading view available. So I'm going to go look at Snowflake as an example. And now I can see Snowflake and how it's performing. It's going on a bit of a good run. Nice. Awesome. So you can't trade against these things because Vema doesn't currently support stocks. And also, if you're looking at the USDT dominance, that's not a tradable symbol. So when you can use this to look at your chart and go, oh, cool, I see what I want to see there. You can go back to previous setup, and that'll take you back to whatever chart you had just a moment ago. So BitGet coming very, very soon to VemaTrader. If you would like to help us beta test on that one, I'd love to hear from you. Support@VemaTrader. The second one is market data coming to VemaTrader in our next release. Awesome stuff. Oh, I'm so excited about that one. All right, so those are two upcoming pieces. The thing I wanted to show you tonight is I was at an MTC Rise Above event in Melbourne over last weekend. And in the presentation there, I was talking, the topic was risk management. And I talked about how there's 3 massively important things for risk management. Number 1 is your risk reward, which is the single most important metric for you to be looking at when you're setting up any individual trade. The second one is the 1% account risk rule. We looked at why we use the 1% account risk rule, how we calculate 1% account risk. Like, hang on, what does that mean? If my stop loss gets hit into 5% loss, how do I only lose 1%? So we talked about how position sizing can work to make sure you're only ever risking 1% on your trade. Unfortunately, due to time constraints, though, we didn't get to talk about the third key takeaway, which is how you can use, if you're following risk reward and the 1% account risk rule, how you can combine those two together to really simply analyze your data using expected value. And that's what I want to go through tonight. So let's go down to the slide we were looking at for this one. Bam. So, all right. So the third thing, well, if you were at the MTC event, this would be the third thing. The thing we want to talk about tonight is what is expected value. And so this is how you can super quickly, super simply analyze your trading performance. And quite simply, it is the expected return of each individual single trade. See, when you're looking from a mathematical point of view, or you're doing some basics, some statistics, then you want to say, hey, if I take this trade, what are the chances I'm going to win the trade? But also, what are the chances I'm actually going to make money on the trade? And when you're using risk reward, you don't need to be winning every single time. Just quick recap on this part here. If you are doing 3-to-1 risk reward trades, then you only need to be correct 30% of the time for you to be making money, for you to be considered a profitable trader. And the higher you make your risk to reward, so if you're doing a 5-to-1 risk to reward on your trades, then you only need to be correct 1 in every 5 trades, and you're going to be making money. You're going to be a profitable trader. And so this part here is looking at your win rate. So if you can get the win rate on your side and you can get risk reward on your side, well, great. How can you tell how your performance is going inside of trading? Not just looking at your account balance and saying, hey, my account balance is going up. That's fantastic. There can be cases where your account balance is going down, but if you analyze your data, you from a certain perspective, you'll see, oh, okay, if I stop doing those things that aren't working for me, then all of a sudden that gets rid of my losses, which increases my win rate, which means I'd be making money. And so the expected value enables you to find that out really, really, really quickly and super easily using VemoTrader. So just on VemoTrader, if you have inside of your trade plan, let's go to Vema for a second and let's go set up a trade. We'll set this one up pretty quickly. Long, inside of our risk management, we're already risking 1% of our account, which is 0.2 of the takeaway. And the other one is the minimum risk to reward. So my trades say that I must have a minimum risk to reward of 3-to-1. You can customize this so that when you open a new trade plan, it's going to be on your minimum risk to reward as well. So that's rather awesome. So that means I only need to be correct 30% of the time. But hey, other traders want to be correct. They might have 5-to-1s going, and so they only need to be correct one about every 5 trades. And now, if you can increase your win rate, then all of a sudden your profitability just skyrockets, which is super, super cool. All right, so quick recap on those two. Let's see, how do you calculate your expected value? The mathematical formula for this one is you take your win rate as a percentage rate, see it 20%, 50%, whatever it is. You times it by the average achieved risk reward on your wins, which would hopefully be your minimum risk to reward, be it a 3-to-1, 5-to-1, 20-to-1. And then you subtract that number from your loss rate, so the percentage of trades that you lose, and you times that by your average risk reward on your losses. Now, because you're doing 5-to-1 or you're doing 3-to-1, that the average risk to reward on your losses should be pretty damn close to 1, because you're only ever risking 1% of your account, and because you are doing some risk to rewards that is like 3-to-1, 5-to-1. I mean, you're not really going to hear of a risk reward ratio of 3-to-2. That would just be a 1.5-to-1. Anyway, so let's talk about the expected value of a coin flip. I need a volunteer, and so Jake, I'm going to do this with you, man. You don't have to do anything. I'm just going to use your name. So the expected value of a coin flip, we are flipping a coin and we know it's got a 50% chance of landing on heads and a 50% chance landing on tails. So hey Jake, if you go ahead and flip the coin and you win because you land heads, you're going to get $5. Fantastic. But if it lands on tails, then you're going to lose $5. You're going to pay me $5. So that's fantastic for me, but kind of sucky for you. So if we just keep on flipping that coin, flip, 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 50-50 chance of winning, you're going to win a bunch, I'm going to win a bunch. The law of very large numbers says that, well, if you just plug that into the expected value calculation, then we'll have 50% win rate times $5, and then 50% win rate times the $5, because I get $5 when you lose. We're going to subtract those two numbers from each other, and so the expected value of any given coin flip is really nothing, is zero. I'm getting paid $5 to pay attention to them. And you never lose. Well, let's flip the odds in my favor, so against you. So now you're going to lose. This sucks for you, I guess. Expected value is now not in your favor. What we've done is we've said, yes, it's a 50% chance of winning and a 50% chance of losing. So the odds of winning or losing are still exactly the same. What we're going to change is the return on your win. So the return on your loss. When you win, we flip the coin and it lands on heads. Jake, you're going to get $5. Awesome, go you. But if it lands on tails, you're going to pay me $10. So when you win, great. And when you don't win, it's not exactly great. You're going to double your loss on all those. So we take that into the expected value formula, 50% win rate times $5 when you win, subtract 50% times $10 when you lose. And now all of a sudden we're getting down here to your expected value on any given coin flip is negative $2.50. So that doesn't mean on any given flip, you're going to lose $2.50. It means that, hey, cool, you could flip and flip and flip and flip and flip, and you could win a few, lose a few, win a few, lose a few. You could even, like, nothing in here says that you couldn't just get heads, 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 and bugger, you've taken all my money because you're an absolute legend and you're winning. This doesn't take into account individual coin flips. It looks at it from an overall perspective over many, many coin flips. How much can you expect to win, or in your case, lose on any given coin flip? So playing me on this regard, hey, you want to play on, you're going to lose $2.50. You can expect to lose $2.50 on any given coin flip. Jake, I don't think you really want to play that game. Correct me if I'm wrong in the chat, but I think you would hear those stats and go, why would I want to play against you, Richard? No, but if we could switch places here. So we'll put the odds in your favor now. We have a still 50-50 chance winning and losing. But when you win, when you get a heads, you're going to go ahead and score yourself $10. Awesome. But when you lose, when it lands on tails, you're going to have to pay me $5. So now we put the values into there, 50% times 10 on our wins and 50% times $5 on the losses. That works out to be the expected value of any given coin flip is going to be you're profiting $2.50. Again, individual single coin flips, no, you're not going to win $2.50. But overall, many, many coin flips, based on these stats, you can expect that you are winning $2.50 on any given coin flip. Basically, you're turning yourself into the casino if you're playing this game, and the odds are in your favor. So the casino knows that when they play blackjack, some people are going to win. They know that Jake is going to win every once in a while, and Jake's going to go, hells yeah, I just profited a few $1,000s, and he crosses his hands. Hey, Jake, you want to keep playing? Nah, I'm up, and he leaves the table. Bugger. But you know what? The casino knows that the expected value of blackjack is going to actually make sure that the casino wins more than they lose. And so they know the expected value of playing the game is that they're going to profit in the long run. So bugger, Jake won tonight. He takes a few $1,000s home. Have fun. But hey, let's keep on playing because we know there's lots of other people that are going to lose. And so the casino is going to win. And so how do we apply this to trading? Well, the cool part is you can do the math on that, but to do that, you've got to be tracking all your data in absolute meticulous detail, which most people just straight up don't do. It's a pain in the ass to have to every single trade go ahead and take a screenshot, go to a journal, put in your notes, and then say what your risk reward was. And oh God, if it won, what the fees are. Instead, you can just use VemoTrader because VemoTrader makes it so freaking simple to do. It does it automatically for you. Because VemoTrader is automatically tagging your trades by 20 different data points, and you can throw as many of them as you'd like into it yourself. And we've now got custom journal templates, so you can put in your entry condition rules and see which ones are working for you. All of those tags, you can say, hey, apply this tag to that set of trades. Only show me the set of trades that have that tag on them and tell me the expected value of those trades. So as an example, I don't trade Fridays anymore because according to my data, it says that, hey, if we look at all of your Friday trades and we look at your expected value, Richard, your expected value of trading on Friday is that you can expect on any given trade that you're going to lose 0.5% of your account. So this expected value of negative 0.54 means how much your account value, your account percentage change is expected to be on any given trade. So I can expect that I'm going to lose 0.54 in any given trade. Hang on, how come it's not 1? If I just lose on Friday, shouldn't it just be straight up, I can expect to lose 1% of my account in every given trade? Well, it's because I don't lose every single trade on Friday. I have a win rate of 10%. Not exactly great, particularly when I'm trading 3-to-1 trades. So whatever happens on Fridays, I don't know. I just can't read the markets. Maybe something else happens. I don't know. I'm too tired on Friday. I don't know what it is, but for some reason, Fridays just don't work for me. So when I do win on those 10% that I do win, my average achieved risk to reward is 4.2 to 1. Awesome. That's pretty cool. But you can see here, hang on, Richard, do you really have that much data to talk about this? Because overall, you've lost 4.8% of your account. Risking 1% of account means you've probably lost 5, maybe 6 trades there. Yeah, so unless it could have been that I won 1 trade and lost 9 trades, but that 1 trade was like a really, really good risk to reward. Either way, I could, if I didn't know what exactly was going on here, I could click on the Friday link here and it would show you, here is every single trade you've taken on Friday for me to analyze and figure out what's going wrong. But if I want to become a more profitable trader, if I look at this data, I just need to say, well, what's not working for me? Fridays. Don't trade on Fridays. Put that into my trade plan. Is it a Friday? Yes. Don't trade. Oh, okay. Cool. And now all of a sudden, I will no longer be losing those trades. I will no longer be expected to lose 0.5% on every trade. And that will increase my win rate overall and make me more money. Yes. We look at Wednesdays. Wednesdays have got a win rate of 52%. I don't have as big of an achieved risk to reward on my wins. So I don't know, maybe I'm cutting my stop losses. I'm pulling my stop loss too tight. My take profit's not far enough away, whatever it is. It's just not, it's a 50% win rate, which is pretty great, but it's not exactly the best achieved risk to reward. So overall on Wednesdays, I can expect that I will win. I can expect that on a given Wednesday trade, I can expect to grow my account by 0.25%. So that's pretty awesome. All of a sudden, I'm now turning myself into the casino and just waiting for Wednesdays to trade. Doesn't mean randomly every trade on Wednesday, I just take a random trade. No, I still want to apply all my regular trading rules to my trade plan in place. I still want to keep all that stuff there. It just says if you can replicate what you've done on prior Wednesdays, every Wednesday, you can expect to be making money on your Wednesday trades. So Vema, you can look at that by the 4 hour, by the 1 hour, by the 5 minute, whichever time frame you want to trade on, whichever strategy you're using, being long, shorts, crosses, Bitcoin, or every altcoin. But one that's really, really fun that I like is to look at how I go on particular patterns. Now, ascending triangles, they're the first pattern that I learnt. They're super easy to spot. And so I really like ascending triangles. They're my jam. I love trading them. And so I can expect that in any given ascending triangle that I identify that is going long, that I'm going to grow my account by 1.63%. Bam, I've turned myself into the casino. So what do I look for predominantly? I look for ascending triangles. I have got a win rate of 60% on my ascending triangles, and my average achieved risk to reward when I win is 3.4 to 1. So fantastic. Richard, go find more ascending triangles, but just don't do them on Fridays. And so using the expected value and using that to analyze a large number of our trades, we can very, very easily see what's working for us and what's not, and what we want to go ahead and change inside of our trade plan to say stop doing that. All right, cool. So that was the last part of the MTC presentation that I unfortunately did not get to cover in Melbourne. That's what I wanted to cover for you tonight. Just, hey, performance analysis, expected value. And if you were unable to attend that event, which was very cool, I'm very happy to do another presentation to you where I just go through all these three things again, because they are risk management in a nutshell. And if you follow these three things, you follow risk reward, as the thing that you want to be looking at when you're setting up a trade. When you follow using 1% of your account per trade, and when you use those two, it enables you to use expected value to analyze your trades. Or VemoTrader automates all of these things for you and makes it super simple for you to turn yourself into the casino. Because if you can turn yourself into the casino, great, just keep calm and remember, the house always wins. All right, so that is what I wanted to cover in tonight's call. The fun parts of these is the open Q&As. So is there anything else that anyone has any questions on? I would very much so love to help you out. And if you've got any questions on VemoTrader, why did a trade execute? Why did it not? How does a certain entry condition work? Yeah, that's what these calls are about, and I'd love to hear from you. So please feel free to unmute yourself and fire away, or throw it into the chat. This is usually where I'd take a break and take a drink, but I left my water bottle somewhere else. Bugger. Let's see. Where was it? There was someone on this call early. Here we go. So Plasterix, you were asking earlier, hey, as a VemoTrader customer, do I need TradingView separately to VemoTrader? No, you don't. The thing you would have used it for in the past would have been, I wanted to go ahead and check out the Bitcoin market dominance, or maybe look at the ratio of Ethereum to Bitcoin and see how they're performing against each other. Now you'll be able to do that directly inside of VemoTrader. Bam, awesome stuff. Should press that one button over there. There we go. All right, so if no one's got any questions, if there's nothing else I can help you with tonight, then guys, hope you've gotten something out of that and seen expected values pretty cool. We are looking for people to help us test BitGet. So if you are interested, then please get in touch, support@vemotrader.com. I'm going to put our email into the chat. Plasterix, so I can chart other exchanges as well. Yeah, absolutely. So when we release this new feature, yes, you will be able to. So inside of Vema, we've got BitGet coming very soon, BitMEX, Bybit, OKX, and the Concept Trader. When you switch this over to market data, it is basically everything that TradingView has. So you'll be able to go BTC, USDT, and go check it out how it's going on Binance. So I know a few people like to use the OBV, on balance volume indicator, and check how that's going on Binance. Because that's the biggest exchange in the world by volume. And then from there, they go, hey, let's go and talk about something. Let's use that to see, do I want to take a trade on the exchange I'm actually trading on? Let's see, Jake, do you have most of the indicators in Vema? So all of the built-in indicators that are inside of TradingView are also here inside of VemoTrader. So if you want to use the RSI, it's right there. If you want to use the CCI, you can add that. That one's annoying. If I switch over to Vema's charts, I can add the CCI, I can add the RSI, I can add the OBV. Oh my goodness, let's keep on adding more things. Smooth moving averages. You can add as many indicators as you would like into VemoTrader's stuff, but it is what? I forget what I was going for there. It is. All the built-in indicators of TradingView are right there. I forget whatever sentence I was going there. John Roach, what about alerts? Is there a plan to upgrade that ability in VemoTrader? Yes, absolutely there is. Let me clear this trade off and go back to start and get rid of everything. Roach, this is what I would want to do for alerts. So at the moment, well, let me ignore what it is at the moment. Let's say what I want it to be. You come here, you add a trigger. I'd love to go for setups add. And then when we go into strategy, I'd want that to just be alert. And we'll just tell you, hey, price has reached this trigger, send an alert, and make it so you can do it like, hey, I've got a downtrend. Please let me know when the downtrend has been hit. That's what I want to do that's what I think we'll do with alerts next, or not next. That's how we'll do them inside of VeMaTrader. Trigger, strategy, alert only. No entries, no stop losses, no anything. Just sends you an alert with a screenshot in it that says, bam, your alert's gone off. John, would that work for you, or is there a different style of alerts you think you'd be looking for to use? And while you either unmute or put that into the chat, I'm going to ask Brett, how do you do a hedge inside of VeMaTrader? So let's see, that is a fun limitation that we do currently have. You can't be in two positions on the one symbol at the same time. So you can't be in a Bitcoin trade, a Bitcoin long, and at the same time be in a Bitcoin short. You can only be in a Bitcoin long. And if you had two trades set up, you could only be in one of them, whichever one enters first. And then when the second one was to try and go to enter, it would say, hang on, you've already got a long open. There is a bit of a hacky workaround to that, which is using the Bitcoin USDT for the futures to go long, and then using, say, a Bitcoin quarterly on a different exchange. If you're on OKX, as an example, if you search for BTC, you've got the perpetual contract you go long on, and then you can open a short on any of these other ones, because they're quarterly contracts. Not exactly the best solution at the moment. So in future, at some point, yes, we would love to make it you can be in a long and a short. We've made the conscious decision not to do that for now, though, because there's all kinds of extra complications that come up on different exchanges for it. Let's see. John Roach says, sounds good. Awesome. Look forward to putting that one in place for you. Rightio. Just because we're up here, I'm going to go and look at how my XRP trade is going. It's up 1.49. Hell's yeah. Let's go look at it. Oh, no. Not quite hitting my take profit and then falling down. What's going to happen with this? Is it going to follow that trend? I'm forcing that trend now, kind of just pushing it, say, make it work, make it work. Anyway, all right, cool. So I'm not going to move my stop loss up on this. I'm going to leave it right where it is. In that case, everybody, if that's what we've got for tonight, then that is all we have for tonight. Thank you so much for spending your Friday night jumping onto a call with me. Hope you learned something interesting. And if you have any questions, I would love to hear from you and help you get sorted out. Thank you very much, everybody. Have a lovely night. Oh, bam. Sorry, Brett, you've just asked another question there. Can you trade USD and USDT? Currently, Vema is focused on futures only, and futures are all based on USDT. So you can't do USD stuff just yet. Next, so we're at a crossroads here. We can either do spot trading on crypto, or we can get into stocks. And we're kind of heavily leaning towards stocks because that gets us into ASX and US markets and Hong Kong markets and UK markets. So yeah, unless something really massively pops along and says, go do spot first, it's probably going to be stocks if we can make it happen. Hope that answers your question. Bam. All right, cool. In that case, everybody, thank you so much. Have yourselves a lovely weekend. Bye-bye.